This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this chapter, we're going to expand our knowledge on chargeable gains for companies by looking at reliefs. Now, as I've discussed before, you have an individual chapter on capital gains tax which discusses rollover relief. So it is important that if you haven't watched that chapter, that you please stop watching this one and go back and watch that one, because all the rollover relief rules and the conditions and examples are dealt with in depth in that chapter. And I am assuming that when we get to this chapter that you've already done that. So if you haven't, please will you go back, otherwise a lot of what we're going to do now won't make any sense. So it is important that you go back and do that. So rollover relief is one of the major reliefs, and it's the only one that limited companies get. So they don't get gift relief, they don't get bad relief, they don't get investors relief, they don't get letting relief, and they don't get PRR. None of those. They only have rollover relief. So quite often in an exam, rollover relief will be tested as part of a corporation tax question. So what happens is a gain is rolled over or deferred. One of the words we used in that first chapter is postponed. Now it must be on the disposal of a qualifying business asset where the proceeds are reinvested in another qualifying business asset. You'll remember from the individual chapters that these are the qualifying assets. They must be land and building or fixed plant and machinery. They must, both the old and the new must be one of those. And they must all be used in the business to get full rollover. So the gain is not taxed immediately but postponed until the company makes a disposal of the replacement asset without any further rollover into a third/fourth asset. What we do is we deduct the gain made on the old asset from the cost of the new one, and that's fully explained in that previous chapter for individuals. Where the disposal proceeds of the old asset are not fully reinvested, the surplus retained reduces the amount of the gain that can be rolled over, and you'll pay tax on that. The replacement asset must be bought within that window period, and you must have to make a claim. So example number 1 here, we are looking at checking whether or not we have fulfilled all the criteria. So 1, it is a building, so it's a qualifying asset. It's used in the business, so that means we've ticked that box. That is the original cost. Now it's been sold, so that's the proceeds. And then they bought some land for use in the business, so they've ticked that box. That's what they got. That's what they reinvested. So yes, they have reinvested all the proceeds. Did they do it within the time window? Yes, they did. So all of those conditions have been fulfilled. So what would the pro forma look like for this? So we would have proceeds, 400,000. Less cost of 150,000 from the question gives us an unindexed gain of 250,000. Now we want indexation allowance. And we're looking at the cost of 150,000 multiplied by the factor from the question. Let's go back and check it. 0929 times 0929 129. So that indexation figure is 139,350, giving an indexed gain of 110,650. Now, because the proceeds, as we discussed in the question, were fully reinvested, rollover is fully available, so no tax is due at this point. And always when you're doing these, work out the base cost of the new asset. So the base cost of the new asset is the value, what we paid for it, less what's been claimed and deferred, and that obviously will crystallize, which is a technical term. That gain will crystallize when this building is sold, and it's the base cost that we will use in any process, any pro forma, when that building is sold. 389,350. You will get extra marks for doing the base cost, so make sure that you do that. So we have a second example here. A bought land for use in the building, in the business, so it is a qualifying asset. It is used in the business. That is the cost. The land was sold, so that's the proceeds. And then they bought a factory. Now, they bought a factory, so they fulfilled the time span. But what have they not done? Okay, they have not reinvested all the proceeds. How much did they retain? They retained 15,000. That becomes taxable. So let's have a look at how that would look in a pro forma. Proceeds. 350,000 less cost is a gain, less indexation, so we have a cost of 200,000 times the fraction, which was 0543. 543. Now obviously I'm doing this, I'm giving you the answer, so I want you to make sure that you understand how that works and make sure that you agree with that answer and you can see how it works. Don't just take my word for it, please. Now, because they did not reinvest 15,000, that becomes chargeable. So this is the balancing figure of rollover. So that's the maths figure, which is 26,400. Now that will be deducted from the cost of the new asset, which was 335, less what's been rolled over, giving us a base cost of 308,600. Always show the base cost. Obviously I'm doing it really quick here just to explain, but you've seen it in previous questions, and obviously you have the model answer to look at too. Now, depreciating assets is another aspect of this that we need to look at, and this is a repetition of the information that is in the individuals question. So it's an asset That is, you're going to be examined on either fixed plant and machinery or a property with a life of less than 60 years. And again, these are the rules. So if you're watching this having done the other chapter, then you will understand this is a good experience for revision purposes to bringing everything back to mind. So if it is a depreciating asset, the gain deferred is not deducted from the cost of the new asset. It is instead postponed until the earliest of these three things. Either you sell that depreciating asset, it ceases to be used in your trade, or 10 years, which is the major, that's the kind of line in the sand. And we have an example here of YR Limited that bought land for use in the business in April 98 for £200,000. The land was sold in May 2017 for £350,000. So we have proceeds less cost equals gain. Less indexation, which is the 200,000. And which one of these do you think we will choose? Okay, well, we're going to choose this one. They've given you a variety there. So we're going to choose that one because that's when we bought it and that's when it was sold. So we're going to multiply that by 0.361, giving us indexation of 72,200 and a gain of £77,800. In March 2018, YR bought fixed plant for use in the business, which cost £390, and then they sold that in February 24. So we've done the year ended March 18 calculation. Now we have to look at what happens in March 2024. So the gain here is not deducted from the cost of the new asset. The gain is deferred due to the purchase of fixed plant and machinery within 3 years of the disposal date, and it will become chargeable here at this date when it is sold, and that's the earlier of the 10 years from the date of acquisition. So that's how you would deal with that aspect. This would all be words. If you look in the answer, you will see, so you can see that, and this is obviously a calculation. So when the replacement asset is a depreciating asset, the gain is deferred as in B above. However, if a non-depreciating asset is purchased before the deferred gain crystallizes, the original gain is rolled over and you basically miss out that middle bit. All of that very much explained in the individual chapter on reliefs, and you can see that quite clearly there. So let's have a look at the exam technique of this chapter. As it is the only relief for companies, it's often examined. Make sure you understand the rules, the conditions, and how it works. But it might turn up as a multiple choice question. So let's have a look at how that looks. In the year ended 30th of June 23, Lumpy Limited, had a tax adjusted profits of £800,200. Property income of £45,000. It also realised a gain of £25,000 and a capital loss of £80,000 on assets that had been used for the purpose of the property business. In the previous accounting period to 30th of June 2022, it had tax adjusted trading profits of £520,000 and a gain of £9,000. How much, if any, of the capital loss arising in the year to June 23, which is that one, is carried forward to the year ended June 24. So you are only dealing with losses for capital purposes. The rest of this question is irrelevant, and they've given you that on purpose to see if you understand that capital gains stick with capital losses. So all we're dealing with here is a current year gain of 25,000, which is covered by a current year loss of 25,000, which means there will be nothing to include in the TTP, which means the balance of that 80,000, which is 55,000, is carried forward. Now you might think that's quite mean to give you all that information and you have to pick it out, but that's the whole purpose. Do you understand the rule for capital gains, and can you cleverly pick out from here what you need to deal with and to ignore what you don't? Just because they've given you the information doesn't mean to say you have to use it. Okay, this is a kind of question that's kind of heading towards advanced tax, and some of the questions do more than just simple calculations. They're trying to make you to think outside the box, which is what this one clearly is doing. Or you might get example number 4, where Mighty has been offered £160,000 for a freehold factory and is considering disposing of it. The company acquired the factory in March 1984, and it now has an indexed cost. So you don't have to deal with that. You don't have to deal with that because it's been dealt with. So this also is a kind of question that's leading you more towards how you would have to deal with capital gains in the advanced tax paper. Because it's always been used for business purposes. Explain. You may have to write the chargeable gain implications of each of the following alternative courses of action that Mighty Limited is considering taking to replace the factory. There are 3 of them. This is about writing, not necessarily numbers. You may have to put some numbers in order to be able to explain your words better. But it's all about explanations. Now this on its own would not be a section C question, but it could be a B part of a section C question, or it even might be the A part where you have to write the rules, and in the B part it says they did dispose of it, they did this, but then they decided to do that, or that figure that you worked out then needs to go into a TTP computation. So they're trying to push you beyond and make you think about it. So we've got 3 options. We acquire a larger freehold building, which means they would reinvest everything. So we're looking there at rollover. Okay, because it would, you'd have to explain what the rules were. Acquiring a smaller one, which means they are keeping some of the proceeds, which become taxable. Or the third option is use the proceeds to pay a premium of 180,000 on a 40-year lease, so that's a depreciating asset. So every one of the examples and every bit of the rules that we've looked at in this chapter is covered in this question. So let's have a look at what the model answer shows us. Now, we haven't had a model answer that's 90% words before. So just a little bit of exam technique with regard to words. It would be good if you could write your answers in full sentences. If, however, you struggle with that, then do bullet points. I would suggest that if it's a bigger written answer, that you make some notes first to put all your thoughts down on a piece of paper randomly. Okay? whatever you can do, because then if you've put all the random thoughts in the order in which they've come, you can then take those thoughts and put them in a nice, neat, logical order, which means your answer is like the model answer would tend to be. So it is important. So obviously in the, we've got a gain, we did that in the question. If they buy the freehold, as we said, it'll roll over against the base cost of the new factory. So this is the gain that's rolled over. The whole thing's rolled over. There's the gain. That's rolled into there. And that's the calculation that shows. So that's the rule. And this is what's known as the application of the rule. And we're happy with that because that clearly shows we understand what's happening. If we do the smaller one, as we discussed when we were discussing it, 5,000 is chargeable, which means that that becomes taxable and we can only roll over the balance. And obviously that gives us the base cost. So again, we have a rule. It says, as not all the proceeds were reinvested. That is the rule. The capital gain element cannot be rolled over in full, and some of it will be chargeable. Then you're very specific with the amount that is chargeable, and then show how the balance would be dealt with for rollover. And then the lease. If all the proceeds were used to acquire the lease, then the gain is deferred too. Okay, and there you have the rules which you have written out. Those are the rules from the chapter. Therefore, the base cost of the lease remains 180,000. If before the held over gain becomes chargeable, that depreciating asset, a non-depreciating asset is acquired, the gain can be rolled over as usual. In this question, if the freehold factory is acquired in the next 2 to 3 years, all the proceeds are invested, so the rollover claim could switch to a new factory. In all the cases above, the reinvestment must take place within that time window. So that's an extra point, an extra mark there, because you put in the time span.